Hi everyone, Steve Swanson with themarketforecast.com. I just want to take you through a quick example of how powerful cycles are to help us understand where markets are going. I'm going to use as an example the SPX over the last, 6 months here that we're looking at, and show you how we analyze where cycles are, show ourselves where they're heading, and then how we can invest using those opportunities that present themselves. Let's start from the bottom up of this screen and take a look at how we analyze cycles. Number one, first of all, we do a spectral analysis on the pricing of the market, and we can do spectral analysis also on sentiment. We can do it on volatility, and we can add all those things obviously together. But here's something very powerful. This shows us that by these spikes where cycles exist. Where there are no spikes, there aren't any cycles in that area. But we only want to use the few that are very smooth, very consistent over time. And the first ones that we see here, there's one at 66, there's a very strong one at 38, there's another one at 31, but not as strong as 24. And sometimes if they're too close together, they really represent a little variation over time, because what we're looking at is 512 days of time backward to analyze those cycles. So 512 days is a couple years of market time, and we don't really need that much for faster cycles. But we can see that there's another one at 24 days, another one at 16, another one at 9. Well, the ones that we're using here is a 9-day cycle right there, and you can see how smooth and undulating and regular that one is. And then we're picking up the 24. It's really a 22 to 24-day cycle, and that's this red one right here. And then we're picking up the 38-day cycle, which is the blue line, another very consistent and smooth cycle. Now, we're not just adding sine waves as we look at this. What we're really doing here is we're going through the actual data and filtering it and getting a literal sine wave out of the data that exists. If we see that sine wave start to modulate or undulate or change over time, it's telling me that sine wave isn't active anymore during that period, and that the other cycles, which are more smooth and regular, are active. Well, then our final one over here is a 66-day cycle, this green one. Now what we're going to do is something very interesting. We're going to take these cycles and just look at how they can be found in the data above by adding the same cycles that we have here to the area above. Let me take a look here. We'll go to these cycles, and in the top panel we're going to add those same 4 cycles, so 9, 22, 39, and 64-day cycles, and I'm going to apply that so that it shows up in that top panel. All right, there we go. So those are those same cycles. They're just a little bit bigger because this is the panel's a little bit wider. If I changed that, and by stretching this one out and made them the same, you could see how those are the same cycles above and below that we're looking at. Now, what does that tell me? Well, it just allows me to see how those fit on top of the data and how active they are. But it can be kind of confusing to see that unless we isolate them one-on-one. But the important thing is going to be over here on the right-hand side, telling me where are those cycles going. And you can kind of see by looking at this green line, the 64-day cycle, that it wants to start turning down. And as I'm looking at this blue line here, it's topping out as well, and should be topping out fairly soon and then rolling over. While the faster a 9-day cycle and a faster 22-day cycle this one should be bottoming and turning up fairly soon, and this one should be rising right now. Well, here's something we can do that a lot of people don't understand, that cycles really tell us. If those cycles really exist in the data and we add them together, hopefully it will represent the same data that we took it out of. Now, we're not putting all the cycles back in, we're just putting in the basic, most regular cycles that we see here. And so what we're going to do is come back and edit that study and say, you know what I want to look at is all of those, well, first of all, let's do something kind of fun. Let's take a look at how those fit on the trend. So we're going to change that to true. And I'm going to say, okay, now lay yourself out. Instead of going straight across above and below 0, you can see the amplitude of those cycles at 20 and minus 20 on the SPX. Those represent points. You can see that it's now added itself to the trend, and we're using kind of a Donchian channel behind there. That's what that red line and those two channel lines represent, as what we call a Donchian or price channel. Some services call that. But now if I put in more data here, you can see how we're following that trend up, and we are following the trend sideways, and we're using those same exact cycles. But what we're doing now is just adding them to the trend as well. And then there's one more thing we can do that makes it really fun. We're going to take a look at that, and now what we're going to do is combine them, add them all together. You know what, let me take them off the trend first so that you can see it without the trend. And then I'm going to put the trend on in a moment. First I want to combine those. And so if you add all of these 4 cycles together, this is what you get above. You get a representation of what it says the market looks like based upon just those 4 cycles, only those 4 cycles. Now if I shrink that a little bit, you can kind of get an idea of how close it comes to representing what the market actually did. In fact, if I kind of move it up here and line up that bottom there, you can see how it was predicting and moved according to what the market did right here. We were expecting, with that cycle turning up and this cycle still rising and that cycle turning up and that cycle underneath all rising together, that we were supposed to have a good pointed bottom, a V bottom, and a nice run up. And the same with this top. We had that cycle topping, we had that cycle topping, that cycle topping, and when you combine all of those together, that's the kind of top it provided. Well, we can do that same thing all the way along. But here's the important thing. It tells me every time a major bottom is occurring. Look, there was a major bottom, there was a major bottom, there was a major bottom. And if I come over here and pull it down, remember, this is not trended. This is going straight across, just like this is, above and below 0. We can see that another major bottom was here. You could buy into a bullish trend at any one of these major bottoms that it's showing here. And most of those occur with this blue 34 to 39 day cycle right here. And you can see over here, same thing, same buying opportunity to get into the trend. And we can go backward in time and see the same thing over and over again. There was a major bottom, and we expected some pretty good chop through here. But watch this. We're going to do one more thing, and now what we're going to do is instead of adding these individually to the trend, we're going to add this line to the trend, and watch how well it represents what the market has done. Now remember, these are just those 4 cycles only. So we're going to keep it combined. Okay, we're going to keep all those added together, and then what we're going to do is add them to the trend. And now it disappeared because they're on 2 different scales, but I'm going to bring that scale back right here, and there we go. Now tell me, does that represent a pretty good idea? If you were describing what the market did, would those 4 cycles describe the activity of the market very well, including the major bottoms, where the tops occurred and where the tops rolled over, and the chop that was involved on the way down, or the volatility that we can talk about through these cycles? See how big these cycles became. Now this is different. Normally people use typical sine waves that have no volatility in their height or in their amplitude. These cycles all perform according to the volatility, the amplitude that's actually in the data at the time. And when you have higher volatility, it persists and then slowly tapers off. And then as that tapers off, it comes into higher volatility again. And you can see that these cycles then taper off again, do that same thing over and over and over again. And this is all done mathematically. I don't have to do anything else except one more thing. I want to get an idea of where these cycles are going to be near term. So let's just measure what a typical sine wave bottom to bottom period is, or top to top, on the blue line, for example. Now if I take from the center point of that blue line to the center point of where it bottomed again, and I extend that out, so that should represent pretty close to where tops occur over time and where bottom to bottom occurs over time. I try to take the most recent one because that's what it tends to duplicate, is the period in between. Might vary between 41 to 36 days. So I'm just going to take the most recent one, and we know that if that bottom to bottom is that time, the top to top should be fairly close. In other words, this blue line is expected to top here in another week, week and a half. And that'll put us right into the middle of November 2013. And you can see that this green line is also getting ready to top out. In fact, it looks like it's already beginning to top out. If we drew a line there and said, okay, you know, what's the period between the bottom here to the bottom here? Right there, and then extended that one out. Just double checking, you can see that back in March, April, and May, that one became a little bit out of phase. And it probably is a little closer right now than it has been historically. Historically, it's supposed to represent about 64 days. So I'm gonna extend it out to the more of the average period there, and say, okay, well that was a much tighter one there. But that being the case, the next bottom should be over here. Now, if this is 1 month from October to November, then November to December should be right here. So about mid-December, that one will be bottomed, meaning that the second half of December, and this may come as no surprise to anybody, should be a lot stronger than the first half of December, because we're going to have this cycle topped out, and its next low, the blue one and the green one, its next low should be almost at the same time, somewhere in mid-December. And as everything starts to top out here, are we looking for a major turn down of cycles? Well, we're still in a bullish trend. And when we're in a bullish trend, the downside tends to be a little bit more damped. And what we may end up seeing is from one side of the channel to the other side of the channel as that time period arrives. But we're not, at this point at least, looking for anything beyond that. So we're looking for weakness into the first couple weeks of December, but a strong finish into the end of the year. And that's what cycles tell us. And the fact that they've been so predictably accurate historically, I mean, look at that. And this isn't over-optimized. This is just 4 cycles. Just 4 cycles historically over time telling me what they want to do. And yes, they do vacillate. They do oscillate a little bit over time and change a little bit of their periodicity, but we can adapt for that. But once we know where their tops are and where their bottoms are, it becomes very evident where we want to be. And right now, we're getting kind of toppy on the market. There may be a little bit of upside left here, but we know for the next few weeks, we're going to have some weakness as these cycles turn down. The only thing different is this red cycle, the 22-day, is going to be coming up and subtracting or adding to. Well, as these come into subtraction, this one will go into addition and damping some of that downside weakness. And that, again, is why I don't believe that the downside should probably be more than what we're seeing in this channel width. Anyway, a basic explanation of how we use cycles to predict where markets are going to be. And if you know where markets are going to be, you know where your stocks are going to be. And if you've got some high flyers and you want to protect them, put stops under them, knowing that we've got some weakness coming. But better than that, think about the buying opportunity that will come when these cycles bottom again. Just as we've seen over and over and over again, in a bull trend, the buying opportunities are when those cycles bottom. Good to be with you. Steve Swanson with themarketforecast.com. Thanks for joining me.